Hello and welcome, everyone. Welcome to Rebuilding Trust in a Changing Climate and Underwriting for Tomorrow. I am proud to have an esteemed panel on the call today to talk about the effects of climate change, both on a macro scale and a micro scale. We all have heard of the LA wildfires, $20 billion in loss. It's a critical wake up for underwriters and insureds alike. And the climate-related disasters are becoming more frequent and more severe, and they're just becoming everything we think about from day to day. It's all about climate change these days. And it's no longer sufficient. We know this. It's no longer sufficient for us to just try to price these right and try to get very granular about how we're pricing everything and just hoping that it works out well. So today we're going to talk about helping clients avoid these risks, helping mitigate what we can, helping price accurately, communication with our client. The stakes are high. The consequences of inaction are severe. And we're going to talk today about 3 ways that we can really make a difference in underwriting for climate change and really being a sustainable business of insurance for tomorrow's risks. We're going to talk first about amplifying our catastrophe models in underwriting. So this is a little bit about the data, a little bit about the tech, how we're using that as an industry to bolster the way that we price, rate, and book business. The second thing we're going to talk about is how to implement proactive underwriting risk strategies, how to take that data and those cutting edge models and bake them into the way that we're offering our pricing and are offering our products on the market. And the third thing we're going to talk about, of course, the human element, is how our underwriter client communication needs to evolve in order to make sure that our clients know why we're doing what we're doing, how we're reproductizing our solutions to address the coming risks and keep everybody safe, whole, and keep the insurance business sustainable for years to come. I'm Rose Hall. I am the founder and CEO of RH Business Ventures. It's my own solopreneur consulting firm. I am focused on innovating how risk is managed. I have done work in the construction sector as a risk manager for Turner Construction. I've done consulting and expert witness work for litigation and claims related to construction matters. And most recently, I was the head of innovation for AXA XL Americas, where I worked on risk mitigating technologies that help the insured better manage their risk, both what they are managing themselves and retaining, and then help the insurers better manage the relationships with the clients, reduce risk, provide value-add services, and all of this through technology and innovation. That's what I do. I'd like to introduce my panelists and friends. First, I'll start with Marco Endofato. Please introduce yourself, Marco.
Yeah,
Tell everyone what you know.
thanks, Rose. Yeah, pleasure to be on this panel. To introduce myself, I'm the Chief Underwriting Officer of Apollo Insurance Solutions. We are based in the independent sovereign country of Canada. I wanted to kind of establish that first. Myself, I have 25 years of property and casualty experience, underwriting, everything from massive, large infrastructure projects to E&O programs for HR consultants. I've also been heavily involved in the past 15 years in product development. So, developing the wordings and the rating for products ranging from contractors pollution to E&O for architects and engineers to tenants insurance. A little bit about Apollo Insurance Solutions. We're Canada's leading insurtech. We're the best funded insurtech, and we're the most well known within Canada. Our mission, our goal was to make insurance an effortless experience or a frictionless experience for both brokers and for insureds. And so what we've done is we've focused on commercial lines, personal lines for small business and for individuals to purchase insurance end to end digitally, seamlessly, easy, and have brokers support them on our platform. So yeah, on to the next.
Fantastic. Thanks, Marco. Looking forward to hearing your insights on this. Let's go to Valerie Turpin from Arch Insurance. Would you kindly introduce yourself?
Yeah, thank you, Rose. Hello, everyone. I'm Valerie Turpin. I'm the Property Chief Underwriting Officer for Arch Insurance North America. Arch Insurance is a specialty lines carrier. We are all across the United States and Canada. We have also Arch International. We operate in the rest of the world. I'm very happy to be there. I've been in the insurance industry for 35 years, and I've always been in property, so very happy to be here. Thank you.
Outstanding. Thank you, Valerie. I'm going to go next to Aisha.
Hey everybody, also excited to be here and a part of this panel. I'm Aisha Heaton. I'm VP of Underwriting at QBE North America. QBE is actually Australian based, but QBE North America, we are across the country in every state. And the specialty casualty space is fairly new and really quick for anyone who isn't familiar with specialty casualty. We cover primary and excess liability for third-party risks that don't fit neatly into the typical insurance policies of the standard lines. And this is usually because the insured's operations are unusual or exposed to multi-fatality losses to third parties. So we do offer admitted products, but we're mostly non-admitted. And because of this, we have the ability to tailor a unique coverage to the needs of our insureds. And so I have the privilege of running a brilliant team that's developing a strong presence in the Southeast. And that's driven by that client-centered approach of leveraging our industry knowledge with a deep empathetic understanding of the client's needs. So that human element that Rose mentioned is particularly special in what we're doing. So although my team doesn't currently utilize risk assessment platforms that we're discussing today, we're continually investigating those emerging technologies that can help us accomplish what we're doing. And so needless to say, this is a very interesting subject for me, and I'm happy to be here.
Thanks, Aisha. Appreciate you. And finally, Ryan.
Good morning, everyone. Ryan DeMario. I'm Vice President of Personal Lines Property Underwriting Product Management here at Verisk. Verisk is a global data analytics and risk assessment firm. I've spent about 10 years here at Verisk, largely focusing on development of new solutions, new data and analytics, and transforming existing solutions to really keep pace with the demands of today. I spent over 20 years in the industry prior to my time at Verisk. I grew up in the insurance industry, working for Travelers in product management, really during a period of dramatic transformation and innovation, especially within the product space, pricing segmentation. And then I spent a few years working for Grange Mutual, a company based out of Columbus, Ohio, where my focus was really helping permeate the use of data and analytics across the organization to help drive more fact-based decision-making from end to end in the value chain. Excited about the time, excited to have a conversation today.
Thanks, Ryan, and thanks everybody. I love this panel because if I can just wrap it up in a quick moment here. I mean, we have underwriting from property, which of course we feel like, that's the first thing we think of when we think of climate change effects. But we've also got underwriting from specialty with Aisha, and I love that you've got the two different. It's not just about the property; it's also about the knock-on effects of the other solutions that are out there. If we have to spend more money on property, that's less money they can spend on other insurance products. So I love that juxtaposition there, and we're going to get their opinions on both of those. And then Marco with the InsurTech and Ryan all about the data. So I'm stoked to get this conversation going. And I'm going to open it with a very, very general question because I just want to get people's perspectives and also set the stage for some of our more specific parts of the discussion. How do you feel? And I'm going to start with Valerie on this one. I'm going to start with Valerie and I'm going to go to Aisha. On the underwriting side, how do you feel we as an insurance industry are responding to this climate change, but on a broad level? Valerie, maybe you can get us started.
Yeah, thank you, Rose. We insurance industry, we have included climate change in the definition of our appetite, in our decision to use our capital or to purchase reinsurance, or in the determination of our pricing adequacy for decades. Every few years, when we are in the insurance industry, we see a publication announcing that the past year was the costliest cat year that happened. There is a very excellent publication that Swiss Re published a few months ago that said that they expect the global cat losses to increase steadily by 5 to 7% every year. So as the industry, we are thinking why this rise? And then I want to look at the Los Angeles wildfire to go a little bit to why that happened. And I think that the magnitude of the damage was driven by urbanization. We made the same conclusion when we explained the increase of the frequency and the magnitude of tornadoes or the magnitude of hurricanes. So with the urbanization and the concentration of values, the increase of cost of replacement, you had climate considerations. In the case of the wildfire, decades-long drought conditions, you had the wind, you had the difficulty of access, you have the perfect storm, if I can say that. So what the insurance industries market, the different markets have done to react to this consideration. And I think that the scenario of the wildfire in California can be applied to other cat perils like hurricanes or like tornadoes. What happened is that the standard market is withdrawing from the rise of these exposures. They see an increase of the exposures, an increase of the magnitude, and because they are standard market, they have also an obligation toward the state insurance regulation and the inflation, and they do not have the ability to adjust their pricing accordingly as fast as needed. So they do withdraw, they contract their book of business. So that creates rooms for a second option, which is the excess and surplus market. So we have seen the excess and surplus market growing over the past years in the cat niches, but this market is not necessarily affordable for everyone or not necessarily accessible for everyone. So it's more a solution that has been really developed around commercial insurance. And there are some, other solutions to go for the personal line on that, which is also created a growth of the third option, which is to go back to the last resort option, which are the state fair plans. So if we look in the case of California, the state fair plan of California grew by, I need to look at my numbers, 31% between September 2024 and March 2025. And by 259% since September 2021 to March 2025. So a lot of insurers don't have a solution that are affordable or easy, so they go to the state fair plan. And I think it's because they need to work on, understanding the financial matrix about what's going on. And then we saw the scenario, if you look at Citizen and Florida, the fact that Citizen started and initiated a depopulation plan because of the growth of their book to give back to the private insurance industry those risks. So I do think that there are response to the insurance industry to the climate change, but it's also has to look towards all the stakeholders working together, the insured and their brokers, the insurance industry, the regulators, and the governments.
Yeah, it's a great point, Valerie. It's not just reacting to the climate change and the thing that happened. It's reacting to all the other limitations and constraints around what you can do to respond to it. And that's such an important point. Aisha, would you pitch in on the specialty market? That would be really helpful.
Sure. I think Valerie hit the nail on the head that it has been historically reactive, and now I think it's shifting into something a bit more proactive. In the specialty casualty space, we are seeing the effects of catastrophic losses across all segments. Just a few examples I could think of would be products such as mobile homes in developing tornado-prone areas, transportation with critical road conditions, energy operations. A great example of that would be the Texas freeze, which is a historical billion-dollar winter event in 2021, or even the construction in hurricane or wildfire-prone areas. So when we're underwriting, we have to take into consideration that elevated exposure to the catastrophic events, but it is, as Valerie put, a bit more reactive. We either reduce capacity or pull out in a lot of areas, and that's not really providing the solution that our clients need. So the claim experiences, even with third-party exposure, is volatile, and our drive for that stringent loss control, it's directly correlated to that. And I do see it shifting in the recent years with the technology-driven analytics that we have today.
That's great segue. Let's talk about the technology and the analytics that we have today. Ryan, I'm going to kick it over to you.
Yeah, thank you. Yeah, no, I'll piggyback on the previous comments. I think the industry on the personal line side is definitely in a period of response, still struggling with exposure growth, inflationary impacts over the last several years as well, trying to ensure that the right rate is even available today for policyholders. So they're still in this period of transition. At the same time, we are seeing a renewed sense of investment from the industry. It's growing where they're looking for third-party solutions to understand the value of data and analytics to augment the information that they have available today. There's been a tremendous amount of work being done by third parties to help understand resiliency of materials, best practices for mitigating damage for catastrophic events. And I think the industry is just starting to respond to that and really build the muscle to really support the next several years into the future. The reality is that exposure, inflation, predominant drivers, but climate is definitely a big impact. You know, we're seeing that fires are much larger. We're seeing shifts in where hail is penetrating markets more significantly, more regularly. Um, the other interesting dynamic is that insurers in places like Florida that are very accustomed to dealing with hurricanes, very well-established guidelines and regulations around building codes and enforcement, are starting to see opportunity in California to support the market as well, bringing some of that expertise. It's a different beast than wildfires, but we're starting to see that cat management mindset lend itself to opportunities in localized insurers entering new markets to support kind of the standard space to help depopulate the FAIR plans, the citizens of the country.
I love that little bit of optimism in the doom and gloom type conversations we usually have about climate change. Let's take some lessons from what they're doing in Florida and bring them over to California. I love it, Ryan. Great. And Marco, anything to add on the insurtech side? How do you feel this is we're handling this in response on the insurtech side?
Yeah, just kind of give you also a perspective from Canada, where we're experiencing similar things when it comes to extreme weather events. Our worst loss year was last year in 2024, where total losses amounted to 8.5 billion. Our worst event ever happened last year in Calgary, and it was hail of all things. But when I say hail, they have hail the size of baseballs coming from the sky, and it caused huge damage in the city of Calgary. So whether it's wildfire, flooding, all these events happening in Canada as well. And the insurance carriers are responding in kind of very traditional ways, by raising prices, restricting capacity. But what's really interesting on the insurtech side is that a lot of insurtechs are getting involved with helping them with modeling, with taking climate change models and incorporating them into the underwriting or risk profile. There are even, a lot of insurtechs are looking at even parametric products for hail, for flooding, where the claim payout can respond as soon as it's detected that a certain event happened. So insurtechs can get involved in really, really interesting ways, and they are in both in Canada and the US.
Yeah, the parametric angle is really coming into play here. When weather's a great use case for parametric. Fantastic. Thank you, Marco. So let's talk about cat modeling. Let's talk about how we're anticipating these types of things coming down the pike. On a portfolio level, we know we don't have enough humans to risk assess every single piece of property that exists, right? That's just not something we have the bandwidth to do as an industry. And nor should we, otherwise we'd have every single person in our insurance companies out there doing risk assessments. But how can we use the climate data that we do have to simulate or forecast or predict? I'm going to use those words loosely. Some events that can feed our underwriting model so we can get just a little bit more accurate on how we're looking at these things from a pricing perspective. Love to hear from Ryan, since Ryan's done some deep work in some of this analytics. Please share with us, what we're doing on the predict and prevent side.
Yeah, the interesting thing we like to say in the insurance industry is that history is the best predictor of the future. However, it's not exactly the case when it comes to climate science. So with wildfire, for example, we've seen the wildfire area grow dramatically, even in the last 35 years, 45 years, where it's increased up 500%. We've seen wildfires get larger, and so it's becoming very critical for us to use scientific methods, models, simulations to really put that history into a contemporary context. Very critical for us to understand the present day exposure, leveraging the past, but reframing it given the current day information that we have available to us. I mentioned previously the access and prevalence of data and analytics that is dramatically tied to resiliency, things like the age of a roof in hurricane, wind, hail exposed areas, material information when it comes to hail, understanding defensible space with wildfire. There are scalable and widespread accurate data solutions that are available today that are helping build a natural bridge between the climate models, the CAT models, and underwriting product and pricing. I think this is giving insurers an opportunity to really bring more of that science into the segmented level of rating that is needed. And we're even starting to see regulators become more open and comfortable with this as well, especially in California, who has just now started to accept use of CAT models. So we're starting to see the tides change. I think the science and the model and simulation aspect is increasingly important to really reframe the situation into the current day and really help connect to that ground level pricing and premium setting that's needed to really get the right risk and the right rate.
Brian, well said. And I'm going to put an exclamation point on the word scalable, because that's, labor shortage and, workforce shortage and all those sorts of, we have so much data. How can we effectively use all of it? And I'm going to go to Marco now to see, if we're feeding all this data, some of the insurtechs are doing a fantastic job of pulling data and using that to directly affect it's like a proof of concept, bringing data into the insurance world so we can see how we can then scale that across some of our more legacy companies. But Marco, what can you share with us about the insurtech side and using that data?
Yeah, I mean, absolutely. There's lots and lots of data out there, lots and lots of tools, and Ryan's correct. Like underwriting and the insurance industry and the underwriting practice has been, perhaps a bit too guilty of using historical data to kind of try to predict risk, and so what climate change has forced us to do is kind of try to create a crystal ball of like what could happen and incorporate that into the risk profile. What we've seen done successfully at Apollo is using climate projection models, such as the ones from Environment Canada or the IPCC, and incorporate those in kind of creating a risk scoring for a particular type of property or a particular type of area. So again, it's not necessarily throwing out all the historical data. It's still incorporating it, but also kind of building in these climate change models that have been utilized by these organizations and bringing it into your risk scoring. Now, practically, in terms of trying to do so in a more granular level, what a lot of companies have done and what a lot of tech companies provide as tools is they brought in essentially satellite imagery and geospatial imagery to kind of help incorporate that into the risk climate modeling. So what you can do in essence is kind of take a certain postal code or zip code or a certain even building and really look at what would happen to this area, for example, as the ambient temperature goes up 1 degree, 2 degrees, or et cetera, et cetera. And so you can get a really good idea of kind of what the actual flooding profile may be within 10 years, 5 years, et cetera, and then incorporate that into the risk scoring for that particular property. So yeah, essentially, what I'm saying is we can kind of look at an area, look at a property, and in a very simple example, look at a house and say, well, the fire risk for this house currently is let's say 10, but if we use the climate projection model, if we kind of use all this data about how we know the rainfall patterns are changing and how dry that certain area is becoming, we can kind of like incorporate that into the pricing and incorporate that into kind of our underwriting practice. So again, like I think the key is using this data, using this information, and then starting to incorporate it into our underwriting.
Yeah. Yeah, it makes perfect sense. And we've got all this, data. It's what everybody's talking about right now, that and AI, but we'll put that aside for a second. But Valerie, from an underwriting perspective, how can these underwriters really digest all of this data? And, the data is fantastic, but if we don't really train our underwriters to be able to understand what they're seeing in the data to make different decisions as a result of that, how can we enable them?
Well, there is a convergence of, what the legacy insurance company and the insurtech are doing today. The job of the underwriters it seems to align, between these two type of companies. And the job of the underwriters have changed drastically, not only since the time I started, but also in the past 5 years. So definitely in every company's algorithm models have been fully integrated into the decision process. And as Marco said, we capture hundreds of data points for each insured location, for each perils we want to cover. And it can be anything from, the construction type. We do use also high resolution imagery. We calculate flood potential elevation at any corner of the buildings. So we do have a lot of data. Some of the data comes from the insured, but we do a lot of enrichment of the data coming from vendors, and the availability of external data has increased drastically over the years. So for the underwriter, it will be impossible to compute hundreds and hundreds of data to make a decision. So this is where the models, this is where the algorithm are really helping. I mean, on multiple levels. Firstly, companies started to implement triaging tools where we calculate, we compare appetite with the exposure, that's the risk scoring that Marco spoke about. We also provide for each insured perils, for each insured location, multiple data points that are the aggregation of this information. And they are usually a pricing indication, a loss estimate, and a confidence ratio. So when you have that, you can make your decisions about how much capacity you can deploy, whether if you in commercial insurance, you syndicate your risk or you stand alone, and also some pricing indication. On the other hand, I think the underwriters are becoming portfolio managers now, because every time, they do look at any individual risk, they need to know what this individual will contribute to the portfolio and the company aggregates. If we write multiple risk in the same area, there will be a peak in the aggregate. So there's also a dynamic portfolio management that the underwriters are doing today, which is that what we're going to have and how this one would contribute to the aggregates. So the job is really changing. And I would say now an underwriter is more a proactive portfolio manager, and it's not anymore an individual risk pricing specialist.
I love it. And we're going to talk about proactive underwriting in just a second, but I want to ask one more question about the macro aspect of this, about the CAT modeling. And I want to go to Aisha on how do you feel this may be affecting the other lines of business, not just the property lines?
Yeah, we have certainly seen the trend over the past 2 to 3 years where the insureds are shifting from asking how much limit do we want to purchase and leaning more into how much limit are we contractually required to purchase. And I'm not absolving the firm market and heavy rates in the specialty casualty space of any responsibility, but we have confirmed directly with our agents the property rate increases, which are tied to the increase in catastrophic experiences, have been enormous. And so in response, the insureds are shaving premiums anywhere they can via other lines of coverage. So specifically in those high excess towers where we're excess of 100 million, 200 million, those layers are often not being purchased come renewal time, especially if they're not contractually required.
Yeah, it's a knock-on effect. It is. So we've got the macro, the CAT modeling idea here, and we're talked a lot about data, and I love data, don't get me wrong, and I love technology, but I really want to focus on the human element here because we can bring all this data in, but how do we bring it to life? And I'm going to piggyback on Valerie's last comments about being a proactive underwriter and some risk strategies. So on a portfolio level, we can use that data and start CAT modeling and creating new ways to assess that risk. But on an individual account level and an individual event level, we have to elevate our value proposition beyond just the paper policy. So suppose we get all that stuff we just talked about. Suppose we get it all right. Then how do we go beyond the paper policy to really be a proactive partner in risk? And I'm going to go to Ryan for this one because we're connecting the data to the humans in the underwriting set. Ryan, sorry, what would you like to share with us about how you've worked for insurance carriers, supporting the industry? Are you seeing this mindset, taking the data and moving it into this proactive strategy for an underwriter? What can you tell us?
Yeah, we definitely are. We're seeing it in pockets, and I think it's growing as well, where there's that realization that pricing isn't the only lever to pull. There needs to be a level of proactivity, needs to be a balance of coverage options. There's been a far greater adoption of limited loss settlement, ACV, even a bigger embrace in the IoT space as well, where I think while IoT is not new, we've passed that deflated expectation, and we're now starting to see third-party device manufacturers offer interesting, unique services to complement the device. So it's not just a proactive like warning sign. There's an aspect of resolution in there as well. So we're starting to see the adoption. The biggest challenge still remains data. I know we just talked a lot about data, but most insurers are still struggling to unlock data to really evaluate the value and the benefit of doing this. But the reality is you need multiple tools in that toolbox. There's no silver bullet. You need to adopt a blend of everything to really manage the proactive nature of these risks.
Yeah, agree. And IoT is great for letting you know that something's about to happen, but a human's got to make a different decision as a result of that information in order to have a different outcome. Marco, would you like to pitch in on this one?
Yeah, for sure. I mean, from the perspective of Apollo and kind of some of the things we've done, we've in particular concentrated on wildfire risk and kind of like incorporating some of the data and some of these learnings and some of these devices in order to kind of give our customers enough information to help them adjust and mitigate for a wildfire event specifically. And so we know looking at the data, and we know looking at, again, going back to the climate change models and all the data that's available on kind of like, we have pretty good understanding of the areas that are at risk for wildfire. So we're able to preemptively talk to our insureds and talk to our brokers about what's going to happen in this upcoming wildfire season. We're able to kind of communicate with them with additional information on how to mitigate for that event and how to help make adjustments if they're required to do an evacuation, or how to protect their property simply in the case of a wildfire event. We're also able to integrate our system into Environment Canada and some of the provincial agencies. They have devices that can sense stuff like the level of humidity, the scale in which air quality is getting worse due to wildfire, and we're able to use those devices and the sensors and the data coming from those devices in order to give real-time communication of like, well, your community now and your area is immediately under threat. These are the steps you need to do, and we've integrated it into our system so we can communicate to our customers through text and through email. And we find that it's assisted greatly in terms of the situations where people have had to evacuate due to wildfire. They've been more prepared. It's helped to even mitigate the losses on additional living expenses, which is a very common coverage in the personal line space. Overall, we think that using the data, using these types of devices, even if the devices aren't necessarily linked to that insured, it could be from a governmental agency, or it could be from a third party, but you can use that data in real time to again be proactive with the communication to allow them to allow the insured to mitigate risk.
Yeah, one at a time, right? And I'm going to go to Valerie now because I want to learn a little bit about, if we have a bit of more information on what's coming down the pike, and like Marco said, the after effects, being able to plan for the after effects. Look, first and foremost, natural catastrophes, they're human life, right? Human life first, 100%. Being able to care for, being able to protect human life and care for those who are affected afterwards is number one prerogative. And then after that, we think about, the financial impacts of what's occurred. But what can we do on the preventative side? What kind of, and let's put data on a shelf for a minute. Let's suppose data tells us we've got something coming. How are we preparing logistically? What are the things we can do mitigatively once we learn that there's something to address? And Valerie, how are underwriters
Yeah.
supporting clients in leveraging preventative measures?
I think all carriers have invested in risk protection services. We do have also loss experience feedback from our claims people. We can evaluate the effectiveness of risk prevention measurement. I think that we have a lot of information, and it's the duty of the insurance company to share this knowledge, to educate our insurer, to publish white papers, to continue to get the knowledge and the awareness about what is possible. I think that we need also to give incentive about that. So people will think about price discount. I don't think this is, yes, there will be price discount, but it's not proportionate to me for what really the real incentive is. I mean, at the end of the day, it's protection of the properties, protection of the life. It's really that consideration that should be foremost. But I think that what we can also advocate a little bit more is that a thorough prevention plan unlocks capacity and provide access to markets, insurance markets, that otherwise a risk would not have. I mean, we all love a good prevention plan. We all love a very proactive insurer. And then the outcome, we should not think about only pricing, but about that I have more appetite to protect your properties. I can put more capacity. That is, to me, a much better leverage and incentive for our insured. But the education is needed. And the education needs also to be common with, as we said, government, preventive measure from electrical company for wildfire, for example. Those are the items that should be done in coordination with the insurance companies as well.
I love the way you're thinking about that, Valerie. It's about a partnership. It's about being proactive. I was a risk engineer for many years, so I totally identify with that. And the thought leadership aspect of it, I mean, what we're doing right here, right? Creating awareness, creating understanding, focusing on the connection between the information you're getting from the data and the actions that humans are performing, whether that's an underwriter or an insured, whoever it is. I think that's super important. And that's a great segue to our last point that we want to talk about with respect to this, to addressing how underwriting is changing for tomorrow. How can we use everything we just talked about to better communicate with our client, to create that trusted relationship so that they're coming to us, the insurers, for advice, for partnership, for guidance, and creating that level of trust. So we've got to evolve into an underwriter that's more than a transactional salesperson, earning trust from the client so we can educate, prepare, and support them through this next phase of climate change and this next phase of risk. So what's the underwriter's role? How do we feel about the underwriter's role in enhancing client relationships and achieving that strong rapport that allows us to have more influence on these outcomes? I'm going to start with Aisha, and we were talking earlier, you've got a couple of great points on this. Please share them.
Yes, well, and I'm very passionate about this. So, You know, today with technology in everyone's hands, the first question that comes to mind, for me at least, is what value are we bringing to the table as underwriters, as the people involved? And I feel like it goes beyond the social responsibility that we previously mentioned to help alleviate the potential for effects of the catastrophic risks, but I'm mostly interested in elevating our role as underwriters in this digital driven world. We should complement the data and the information that we have access to. And I believe that comes down to two pillars. I would say one, our ability to interpret the information our models are providing us, which I love what Ryan had mentioned, that it's not just you don't have one silver bullet, you are using several tools to do that. That's intriguing. And I feel like it's dependent on the quality of the tools that we're using, but also our ability to look at the information, to zoom out, to paint an overall picture that caters to our clients' unique needs. We have to approach our clients with a sense of empathy. What are their pain points and struggles? Where can we help guide them in mitigating those risks with the digital platforms that we have?
Yeah, empathy. It's not a word you hear very often as it relates to, client relationships and sales and so forth. And, Valerie, support from insurers comes from a lot of different places. What is Arch doing to help enhance that client relationship?
When we look at the role of the underwriters, as portfolio proactive manager, but also as a coordinator, I think that there is a collaboration that the company should use, all companies should use, is that you have the claims people, you have the risk control, you have the underwriting, you have the cat modelers, you have the partnership with brokers. Let's not forget brokers and all the services they do provide to their insured as well. I think that I see the underwriter role as coordinating everything, so we can differentiate between clients. We can tailor-made for our clients. We can, provide solutions really adjusted to what a client needs, but also what their exposures are, instead of having portfolio across type of strategies. I think that the way to look at it in the past, which was that I'm going to have, an across the board, across portfolio reaction, is not something that it's sustainable now. We need to be more differentiating. We need to be more client focused.
Yeah. Yeah, absolutely, Valerie. Thank you. Well said. Marco, do you want to just add something to the end of this?
Absolutely. I love this question as well, because it kind of speaks to my experience at Apollo. So as I mentioned, Apollo's whole mission statement is to make insurance as effortless as possible for the insured and for brokers. And so part of my mandate was how to make underwriting not so intrusive for the insured. And so of course it came down to making sure that underwriting was digital and automated through algorithms, so logic algorithms. It was also part of my mandate was also, like, instead of asking so many questions and being intrusive, could we extract data from third-party sources? And we did that, and we were quite successful, and we are quite successful in doing that. And so we got the insurance experience, or the customer experience buying insurance, down to minimal questions. And a lot of customers responded really well to this. They loved it. They were like, oh, this is really easy. But an interesting side effect was that there was a lot of customers that were like, is this it? Where's the PDF? Where's the tons of questions? And so then that kind of changed my mentality about underwriting as well, in terms of having it traditionally be in the background, and we wanted to kind of put it back into the foreground. So instead of asking all those questions and kind of implicitly having the customer understand what's important to the underwriter, we actually are upfront with it. So we don't need to ask the questions, but what we do is, in our customer experience, as soon as you put down the address, we can kind of tell you, okay, the crime in your neighborhood is according to us, this category, wildfire risk is this, flood is this. And so immediately the customer kind of has this awareness of like, okay, this is what the underwriting is based off of. They didn't ask me all these questions, but I know that they know this is what the underwriting is based off of. And so in essence, what it does is it creates it turns the underwriter into a bit of the educator for the customer. So the customer is being educated a little bit about the underwriting process, so they're not necessarily caught off guard by the terms and conditions that they're being presented. It's also an opportunity, to be honest, to have the customer to kind of think about, well, maybe we should buy this coverage or this peril in addition to all the other ones. So that's kind of what happens kind of when you really automate the underwriting process. You kind of have to kind of change your mentality a bit with how you're presenting to the customer. The other thing we did was we wanted to kind of make the product, and Valerie mentioned this as well, we want to make the product as flexible as possible so we could kind of adjust according to the individual's risk profile. So not only do we present our thoughts on the underwriting exposures and the risk exposures, but we're also kind of presenting to them why we're presenting certain terms and conditions. And what's also extremely interesting is we found out really, really quickly that there's a certain segment of customers, a big segment of customers within the tenants insurance space, that their contents value is less important than we think it should be. So we have a lot of competitors that are enforcing a certain minimum on contents limits for their insureds, but when they come to us, they actually don't care that much about it. So they lower it every single time, but they're taking the savings there and purchasing other coverages on other types of perils that they're actually more concerned about, or they're increasing special limits, or they're adding stuff like identity theft coverage and things like that. And so again, the digital experience can be easy, but then it can also be very informative. And that's kind of underwriters' role, is to kind of inform the customer on how we're measuring risk, but then also giving them the capability of like sort of making decisions themselves. Like if they want to increase a certain limit, let them increase a certain limit. If they want to lower a certain limit, allow them to lower a certain limit. I think the insurance industry has been a bit too guilty in the past of like dictating a bit too much to the customer, not thinking about really what does the customer want versus what do we want, right? Yeah. So yeah, that's been our experience, and from an underwriter perspective.
Yeah, I make a joke all the time that the insurance industry thinks way too much about insurance. But that's how we think about risk. We think about risk in terms of policies. And you bring up a good point, Marco. You can provide all the information and all the programs that Valerie's talking about with respect to providing data, the analytics, the recommendations for mitigation. But are the clients coming with us on this journey? And my question to you, my last question before we do closing remarks, and by the way, I'm going to put a shameless plug in here for questions in the chat. We may have time for one or two. So I see one already, but if there's any others that would like to ask a question of the panel, please put it in the Q&A. Back to the topic at hand. Do we think the insureds are holding up their end of the bargain to prevent and mitigate where possible? Or are they doing the I don't need to worry about it, I have insurance thing? Let's start with Ryan on this one.
Yeah, this is I mean, insurance is an expectation of duty of care. In the personal line space, I think that misperception that you just described is still very prevalent. Human nature is, as a homeowner, I'm going to invest in the cosmetic, the things that potentially increase my property value. But in states where there has been tighter regulation, a better understanding of resiliency and the benefit to property values, you start to see that happen in Florida, where the first sentence for a new real estate listing is the age of the roof. It's a selling point. It's not just the look and the feel now. So I think there are markets where this is starting to become prevalent. By and large, though, it's still the case in the personal line space with the average everyday homeowner. That's where the collaboration that Valerie, Aisha, Marco alluded to earlier, very, very important, that mindset of the not binary yes, no. It's more of a collaboration opportunity and education opportunity. And there's also a need for local jurisdictions, contractors, material manufacturers to do their part as well, to start to adopt and utilize more resilient materials, ensuring that they are lending a hand to protect communities as well to close this gap wherever possible.
Absolutely. Absolutely. Aisha, I'd love to go to you on this one.
Yeah, I'd have to agree with Ryan. It's a dual reality, right? The onus is on the insured, and there is a strong level of responsibility that falls on the insured to meet the level of care and duty that they need to in order to receive appropriate rates and coverage. But we as underwriters are setting the bar for loss control. In my world, I would say most of the insureds often set their standards based on industry requirements in conjunction with what we're specifically seeking as the underwriter. So it's up to us to educate and to elevate the risk mitigating demands to meet the current climate, no pun intended, of experience that we're seeing. And there's a lot of room to grow when it comes to this. Certainly, intelligent systems we could eventually utilize that become more prominent tool in our industry. And I'm excited to hear that that's where we're going today.
Yeah, absolutely. Without and what we have as the insurance industry that the clients are desperate for is a benchmark of where they stand compared to industry standard, right? So if you go to the doctor and you get your blood work done, then and they go, your cholesterol is this number. And then you go, well, I don't know what that means. Is that good? Is that bad? What is this supposed to be? Right? And the insurers, we have the data that says, hey, you're doing this, this, and this. This is above and beyond standard protocol, or this is below standard protocol. Sometimes we just don't know what we're responsible for, So as the insurers, having all this data to be able to share with the client, well, you're kind of in the middle here. We'd like to see, if you wanted to up your game, we'd like to see you do these three things, or not do these three things, or whatever. Like sometimes the education part of it is really the catalyst for the change. Valerie, would you like to add anything to this last comment?
I do totally agree with everything that Ryan, Aisha, and Youssef has said. I would say I would like also to put more responsibilities to the local governments and authorities as well. I think that the fact that some improvement in the building codes are so slow to be included in some counties. The fact also that some of the prevention measure that can be driven, through mandates can help also the insured. I mean, the insured need to be educated, but a little bit of help through, governmental regulations and governmental guidance can help a lot to just provide a higher level of average. How can we raise the average of everybody?
Yeah, and that was one of the questions in the chat too, is how is departments of insurance getting involved in this? So, good way to address that, Valerie. All right, I'm going to go to closing remarks, but before I do, this has been a great discussion. I want to encourage everyone on the call to, if we don't get, we may get to one or two questions, but please reach out to the panelists. I'm volunteering you all. Please reach out to the panelists and engage with them. They love talking about this stuff. Another plug I'm going to put in here is Reuters is having a Connected Underwriting USA conference. I will be there if you want to hear me talk about this insurance innovation stuff some more. It's on September 29th and 30th in Austin, Texas. You can get information on that on the Reuters Insurance Events website. Love to see you there. And the last thing we're going to do is do a quick roundtable. This will be like a lightning round, quickety quick. Climate change can seem like doom and gloom sometimes, right? And we have all these things we're talking about. We want to do. We want to get better at this. We're concerned about what's going to happen next, both on a personal level and a business level. But I want to flip the script for a quick second and get your thoughts on what's the most exciting thing that you're seeing in the future of underwriting. I'm going to go to Aisha first.
Okay, great. I'll be quick. With the unlimited data that we have at everyone's fingertips, we get to be the vessel of that deeper understanding of all this information that we have on hand. We get to learn about our client struggles and desires and help tailor those creative solutions specific to them. And we have an opportunity here to transcend the traditional client underwriting experience And I believe that's what sustainable underwriting looks like today in a digital world. And it's very exciting.
I love that. User experience is not just for digital products. I love it. Valerie, what's the most exciting thing you're looking forward to seeing in the future of underwriting?
I would like to continue, and I think we will see a lot of improvement with the modeling capabilities, the analysis of the risk, continue to leverage the data, and really that will be super helpful to continue to differentiate between clients, help to raise the average of the risk protection and unlock capacity for the insurance side, but also create new financial solutions. I think that data is being used, but we will see the next level of analytics.
Yeah, wonderful. Ryan, tell us what you're excited about.
Yeah, very similar to Aisha and Valerie, I'm looking forward to the walls, the silos that exist naturally within insurance companies to get broken down and for better tools and solutions to be available to really increase the collective GPA across that entire value chain and empower underwriters to do more than they do today.
I love it. Marco, do you have an ad here?
Yeah, I mean, similar to Ryan, like the silos can come down with technology,
Yeah.
and the
Yeah.
customer experience can be so much better for our customers. It can be as exciting as, and again, being in the personal line space, like it can be as exciting as taking pictures of your living room, uploading it. AI says this is all the contents you have. These are the limits. Having that as part of the underwriting file, as soon as there's a loss, it goes straight to claims. Claims get paid right away. Like it can be that good, right? And that's kind of what makes me excited, is like, let's strive for that sort of experience. Like if Amazon can deliver packages so quickly, for the love of God, we can pay claims right away, right? So again,
I
like
love it.
it's exciting.
We've been focused a lot on the underwriting on this call, and I love that you pulled the claims into it too, because that really is the product, right? And
Yeah.
I'll share with you what I'm the most excited about. I'm excited to see the insurance industry become consultants for risk that write insurance products, that write financial insurance products, right? I want to see us evolve into an industry where we are the experts at risk management, innovating how risk is managed, and we become the trusted advisors that also provide the insurance solutions instead of the other way around. So that's what I'm looking forward to. Great. I think we have time for one or two questions, and I'm going to pitch one to the group, and just raise your hand if you want to add into it. How should we be thinking about long-term climate change being reflected in short-term pricing decisions? How do we reconcile that juxtaposition? Anyone want to take that? I'll add a twist to it. I'll combine a couple of questions here. So how do we make these future climate models relatable enough for carriers to adopt them and for us to continue to evolve, especially since the policies are 1 year each, right? Are we able to iterate on a yearly basis with some of this data and prediction, or are we just going to look at this big picture? Are we going to look macro, or are we going to look micro? What do you think's the right way to be thinking about it, at least today?
Yeah, I'll hop in here. So I think it's going to be a little bit of both. I think we have to have that nimble data infrastructure available to make regular change, continue to evaluate simulations, again, putting that history and current day context. I think working with regulators as well to increase their appetite and acceptable use of these models. I think the more that we can do that, there's an opportunity to leverage the long-term insights that are available from climate into the present day immediate needs that meet that 6 to 12 month cycle of rate change that exists in market today. So there's a lot of opportunity to take the macro beyond the base rate level down to the segment level to
Yep.
really connect the dots between cat management modeling and product management and pricing.
Yeah, outstanding. Thank you, Ryan. And I'm going to ask one more question that we may or may not have the answer for, but there was a question in the chat about how this may affect the reinsurance market. And I know none of us are specifically in the reinsurance space, but does anybody have any insight into that?
I can take it. We are very, very close between the insurance market and the reinsurance market. We collaborate a lot. A lot of our data and analytics are shared by the reinsurance market. So the reinsurance market is really acting the same way as insurance market. We are very close. We are having the same conversation about, pricing, risk selection, It's the reinsurance market has, you know, more financial options. So we do see ILS, we do see some other financial solutions, but I think that the way we look at risk is very, very similar. The way we look at prediction, the way we look at models is actually very, very close. And we do have a collaboration that is based on the same fundamentals.
Fantastic. Valerie, Marco, Ryan, and Aisha, this was a fantastic conversation. I enjoyed it very much. I hope the audience got as much out of it. And thank you so much for being on the panel. And this recording will be available to everybody who's registered for it. Thank you all, and goodbye.
Thank you,
Thank
guys.
you very much.
Thanks,
Thank you.
Rose.
Thank
Thanks,
you.
everyone.
Thanks, Rose.